Well, hello there, everybody. This is Morris from SJOPTIONS.com and SJADVISOR.com. If you're a hedge fund manager or trading for a group, make sure to check us out at SJADVISOR.com. We do develop strategies for funds as well as provide some of the most advanced options analytics that you'll find anywhere today. So today's lesson, we're going to be looking at the very famous naked put, but we're going to do a stress test on this strategy. And part of the development process of any option strategy really has to start with some stress testing so that you can see what it does over some of the volatile moves in the market. And when you're working with portfolio margin, and that's what we're going to be discussing today, then you have to be aware that your margins will change rather quickly, and you have to make sure that you're properly sizing your positions so you don't result in a margin call into a forced liquidation that can cause you severe damages. So what we're looking at right here is I constructed a naked put, and I sold at the 5 delta. We're looking at the SPX, and we're going to study what happens on this week, which was August 17th, 2015, and that was a pretty tough week. So the market dropped rather quickly, about 10% in a matter of 7 days. So we want to stress test this strategy over that scenario and see how the margins change, see what kind of drawdown the trade experiences. And this trade is also out about 30 days. So it's very common for option traders to sell premium and try to collect and create an income on a monthly basis. So this one actually brings in about 5% based on that portfolio margin. So first I want to talk a little bit about the margin calculations. So there's one called the TIMS model, which is pretty common in the industry. And it's going to measure down 10%, which you can see here. And then also it's going to measure up 10%. So I'll just estimate it using the little lines here, the vertical lines. So I have 1, 2, 3, 4, 1, 2, 3, 4. So the up 10% mark is going to be about right here. Okay, so the way that the model works is it just measures up 10% and down 10%, and the popular method, I guess there's a couple different forms of this method, but one of them uses a constant volatility for the underlying product. So the model is called the TIMS, and you can research it more online, but it's brought to you by the Options Clearing Corporation, and you can look that up. So a very common one is a plus and minus 10% risk array for products such as the SPX. So you have your minus 10% location there, and then you have a plus 10% location here, and then the model will create various slices as you go up and down that risk array. So it's going to measure the worst case scenario in this risk array, and then this point here is the lowest. So then the calculation would create the margin right there. In this case, it's somewhere in this amount. It's about 52,000 on this particular trade. And so that's really how the margin works. And then as you move farther down this way, it's going to push this negative 10% location farther down. So that's one thing you have to understand. So as the SPX moves to the left here, then so does your margin. So like if you move that much, it's going to move way over here, kind of off the screen, but then your new margin is going to be way down here. So it could essentially go from like 50,000 to over 100,000 pretty quickly if the underlying moves about 10%. So one thing we want to understand is when we're working with portfolio margin is that by design your margins can change, and you really have to think about that when you design your strategy, because it's definitely going to impact the trade. Okay, so now that we've discussed how the basic formula of the TIMS works, and as I understand there's a couple different models, but that would be one where the implied volatility of the underlying product remains constant, and that's a common formula that they use at various brokers. Okay, so next we're going to look at some of the Greek structure of the naked put. So down here we'll see that you have a negative Vega position, and then notice as you move the mouse to the left, that negative Vega becomes more negative Vega. Okay, so this is caused by a positive Vanna position. As you move this direction, since the Vanna is positive, then your Vega is actually becoming more negative. Okay, so what is Vanna? Again, you could look this up online. And there's a couple different ways to use Vanna. The way that we typically use it as option traders is as the direction changes, or as the underlying price moves around, then it really represents how your Vega position is going to change. So if you have a positive Vanna position, then as the market moves down, you have a negative direction multiplied by a positive Vanna, and you get a negative change in your Vega. Then as you move to the right, again, you have a positive direction multiplied by a positive Vanna, and you get a positive change in your Vega. So as you go this direction, you can see that the Vega becomes more positive. And as you go this way, you see the Vega becomes more negative. So that's how I know it has a positive Vanna position. The other thing we can see is what happens when we increase volatility. So I'm going to increase volatility now, and then keep your eyes down here and watch what happens to the Vega position. So you can see as I increase volatility, the trade starts to lose, which you can also see by the P&L information box right here. So the trade loses, and then the Vega also becomes more negative. So that's how I know the trade has a negative Vomma position. Okay, so your Vomma position, again, I recommend you to read about it online and things and further your education on Vomma, but the Vomma represents how your Vega position changes relative to volatility changes. Okay. So next we have to understand the correlations between price and volatility. So let's take a quick look at a price chart. So here we're looking at the price chart in the top block of the SPX, and then the bottom chart tracks the volatility. And from here, you'll see that there's an inverse correlation. So, for example, right through here, your price is moving down and your volatility moves up. Then your price goes up, your vols come back down, your price goes back down, and your vols go back up. Then your price goes up all through here, and your vols move down through there. and then so on. So this is what we call, the rest of it's off the screen, but anyway, that's what we call an inverse correlation of price to volatility. So you'll find this with most products. Sometimes when you look at commodities, and there's a couple out there that don't necessarily have this very strong inverse correlation, but the SPX does, and so does the Russell, and so does the NDX. So the indices have this characteristic. So it's very important to understand this concept when you're trading options. So next, let's go back to that risk profile. So before we fast forward the date to see what happens, just want to recap and summarize the trade. So we're using 52,000 margin based on the 10% mark down. So it's over here, and then it's going to give you a 10% risk. Again, a risk of 52,000 within that 10% risk array. So that's our beginning margin, 52,000. The bar, again, is my terminology. I coined this. It's the bar is at 26.95. So if you do the calculation, it's about 5%. Hold on, let me shut the door. It's kind of noisy. Anyway, sorry about that noise in the background. Okay, so this trade, again, the margin is 52,000. We're trying to make 26.95, so we're trying to make 5% in a month with this particular trade setup. And then we're going to fast forward the date, and we want to see how the margins change and how the P&L changes. So on the first day, I just went from Monday to Tuesday, and the SPX dropped 5.52, and at the moment the trade has a drawdown of 278. So now we'll go to the next day. Okay, so the next day the SPX dropped 17 points, and the trade is currently down 1,649. Now, although off the screen, the new margin is 65,000. So far it's jumped from 52,000 to 65. Now, the next day, the SPX dropped 2% for about 43 points, and the trade is down over 8,000, and the new margin is 96,000. So the margin so far in only 3 days has gone from 52,000 to 96,000. It's getting close to doubling. Okay. Now, the other thing is that I forgot to mention is, what if the trader started with an account of 200,000? Okay, so let's just keep that in mind. So if they started with 200,000 and they were initially using 52,000 a margin, then they're trading about 25% of their account. Okay, so let's keep that in mind as we go. So right now they're at 96,000 margin, so they're using about 50% of their margin all of a sudden. So the next day, this is where things start to get really dangerous for this particular trade. So now the SPX dropped another 3%, and the trade is all of a sudden down 30,000. But the margins have now jumped to 151,000. So we're currently, and we'll just do some of the math here. Trader starts at 200,000. The net liquidation value But now they're down 30,000 on the trade. So their current value has dropped to 170,000. The margin has gone from 52,000 and it's currently at 151, almost 152. Okay, so this is, if you're the trader, you're starting to feel a lot of pressure. Okay, but at the same time, you can see, well, you're only right here, and you still have, 3 weeks, almost a month left. Your short strike is really over here. So you have, at least you believe you have plenty of room and plenty of time to recover. Okay. So this is where the gambling comes in, and that the pressure, and when you have to make these decisions that could really cost yourself a lot, but at the same time you have an opportunity here to make money. You would think that, well, now your volatility rank has moved up, and it could be a time to actually enter into the trade. So you may not want to size down. You may think, well, you have almost 20,000 more buying power here, and if you size down now, you're gonna be cashing out and realizing a lot of these losses. Okay, now the other thing to note is, at the moment, again, you're down 30,000, but you're trying to make the 26. So at the moment, the trade is down over 10 times what you usually make. So this is, at the moment, the trade has already wiped out an entire year of returns. So what do? I know traders that would definitely hold on. They're stubborn, and they just believe in probabilities and think the market would, go back. So let's see what would happen to that particular trader. Okay, so now, and we'll pause it here. Look what's happened. So the stubborn trader is now down 84,000. Let's pull out the calculator for this. Now you're down 33 months. So at the drawdown of 84,000, you've just lost 33 months of consistent winners. So essentially it wiped out about 3 years of returns at that point. And so far the trade's only been on 1 week. Now the other problem that the trader now faces is the margin jump to 226. So your new margin is 226,000. Okay. The net liquid of the account started with 200,000, but now you're down 84,000. So let's say you have about 115 left. Okay, so your account value here is 115. Which means that you have a margin call of about 111,000 right there. Okay, so margin call for $111,000. Okay, so this is the unfortunate situation that the stubborn trader would, eventually would get themselves into. So you saw again on August 21st, they still had 20,000 buying power. Then they go through that thought process where, well, now the volatility ranks really high. It could be an opportunity. I don't necessarily want to exit the trade at such a loss. And I'm going to hold on, one more day, hope for the best. And unfortunately, at that point, the market went down a little bit further. And now the trader has a margin call for 111,000. And their account is down almost, probably 45%. It's almost cut in half in 1 week. Okay. So in this situation, some traders may have the money to meet the margin call. Some may not. But you also have to be aware that your broker, by agreements, does not have to afford you the time to send in your money for the margin call. So your broker could actually just close out your positions at this point and force you to lose not only the amount that you're down on the trade of 84,000, but then there could be liquidation damages as well. So as the market's crashing and then you're trying to cover naked puts, then the market maker can just keep changing the price on you and making that price go up and up. And so you have to pay more and more. And then a lot of slippage could be created. So you could lose several thousand more trying to exit if you're in that situation, because the market maker has all the leverage. Okay. But let's look at what would happen now if you want to continue the trade and size down, knowing that you only have 115,000 left. So I started with 11 and now I had to close out 10 just to get the margins so the trader could continue the trade. So now after closing out 10 of the naked puts, the trader could still hold on and hope the market comes up this way, but they're still risking more over here. They only have one more uncovered put though, but the margin is still 97,000 and their net liquidation value is only 115. So they're still really maxing out those margins. But look what happens. Look where your bar is. So your bar is at negative 76,000. I can actually pull this down so you can see where 0 is. It's way off the screen. It's way up here. Okay. So the best the trader can do at this point is lose $76,000. So let's take a look at that with the calculator. So it's about 30 times. 30 times what you make. Okay, so you can see what would happen. The trader, if they hold on too long, and it's easy for you to say looking back now, oh, I would have maybe closed it out on the 21st, but when you're really in that situation, and I'm sure it happened to a lot of people, so they're holding on because the 21st, the vol's been up a little, and a lot of traders would refuse to exit the trade at that point because they don't want to take the loss. And then on the 24th, well, now you can see that Now the trade has essentially lost 30 months of winners. So you're now behind about 3 years. Okay. Not only that, but your account has now dropped from 200,000 to about 110, 115,000. And so again, if you follow your trading rule of investing 25% of your account, you can't even make the money back in 30 months. Now you only have half the money. So you're looking at 60 months just to get back to break even. So imagine that. It would take you 5 to 6 years just to make back the losses. And that's only if you have a winning month, every single month, and you never lose again. But that's, not likely to happen. So let's see. Let's summarize what we've discussed so far. Okay, so we started with 200,000. And we were trying to make 5% a month on that amount. But then in 1 week's time, the net liquidation value of the account dropped to approximately 115,000. Okay. And, well, needless to say, the 5% was lost, but it actually lost, the total drawdown was somewhere around the 80-something thousand. The new best you could do on the trade after sizing down to meet the margin call is somewhere around a loss of 76,000. So it comes out to somewhere about 30 months of losses. So wiped out just 30 months here. So if you had made, if prior to that, if you just, had winning 30 months in a row of winning trades, well, almost 3 years, well, it's all wiped out now. Then the next thing is now if your new account value at 115, to get that money back, it's going to take you like 60 months of consistent winners, which is like 5 years straight. And then the probability of that is extremely low. And that's just to get back, to where you were before this horrible week happened. So anyway, I hope you find that helpful. Again, when you're developing your trading system, these are the criteria that you really want to stress test when you're trading portfolio margins. You want to look at how those margins are going to change through the volatile times. You want to stress test, how your profit and loss can change. And in this case, you can see that the margins went from 52,000 to, I think it was over like 200,000. And then you had to size down. And then when you size down to meet your new margin requirement, then the best you can do is lose like 30 months of returns on that particular trade. And the other thing is to consider this was using 25%, but it doesn't really matter. Like if you're using, let's say 5% of the count, it's still all relative. So you still lose 30 months of returns in 1 week. And so even if you're only using 5% of your portfolio capital, well, the benefit is maybe you don't get the margin call and you don't blow up the account, but the fact is you still lose 30 months of returns in 1 week. So you can trade longer because your account, again, doesn't necessarily blow up, but you can also see that one wipeout like this will prevent you from realizing long-term gains. So I hope that clears that up for you, and I highly recommend you to do some of your own back testing, but I just wanted to share that with you guys. All right. Thank you very much.